Today we're going to be talking about the importance of the higher time frame, PD array selection, other ways of using the higher time frame, and how the higher time frame looks on a lower time frame scale. So let's get into it. Right, so as you can see here, I've drew out a schematic of the higher time frame and the lower time frame. What I want you to see is this lower time frame schematic is a fractal of what is going on inside of this retracement right here. This box is exactly what this lower time frame looks like. If you zoom in, as we can see on the higher time frame, every retracement is a manipulation down so then we can continue to distribute higher. This means that we're in bullish order flow, we're going up, we're moving up, we're moving up. Does this mean that we can't take sells on the lower time frame? Absolutely not. You can be utilizing each one of these retracement legs as a lower time frame market maker model. So let's say on the higher time frame here, we've got a key level right here. This right here is our key level. Imagine that price trades into this, and we also trade into equilibrium of this PD array. As we can see, we've traded into equilibrium, and now what are we expecting? If we go into the lower time frame now, what you will see is that the equilibrium line will be right around there. If you see the lower time frame dig into that higher time frame PD array, then start to reject. And now what are we looking for? Well, first thing, and most importantly, this needs to be inside of our time of interest. If this isn't inside of our macro time, then you do not have a trade, because our macro times are what frames all of our setups. If our setup does not form inside of our macro time, then we do not take a trade. There are a few times where you can take a trade outside of macro, which I'll be talking inside of my private mentorship. However, if you want to be safe, do not take trades outside of macro time. So, as we can see, we've dug into equilibrium of that higher time frame PD array. Then we have rejected. And what are we looking for now? Well, if you draw out this right here, this low would have been an intermediate term low. We displaced through it, and now this is our change in state of delivery. I'm sure you've heard me talk about this about 100 times, but this pattern right here is super important. As long as you have the correct narrative, you have SMT, you're inside of macro time, this is a high probability setup right here, because every retracement is a lower time frame market maker model. So when we're in bullish order flow on the higher time frame, each retracement is a market maker sell model. Now, because we're trading against higher time frame order flow, what are we targeting? Well, usually we'll be targeting opposite side of the range. However, we're not going to be doing this now. What we're going to be targeting is the equilibrium of this range. As we can see here is the reaction of this lower time frame left side of the curve. If price reaches equilibrium, which, just so you know, usually price consolidates around equilibrium, so there's a high likelihood that there will be a low lined up with equilibrium, right as this example does. What I want you to notice is where we drop down below equilibrium, come into our discount of our range, and if we reject off of equilibrium after sweeping this low, which is usually a time-based low, we sweep that, we're inside of discount of the range. Now what are we looking for? Well, if we see price displace above this intermediate term high, what's that again? That right there is our change in state of delivery again. Now what are we targeting? We're targeting opposite side of the range, and after we take our opposite side of the range, what are we targeting next? Well, this is where the higher time frame comes back into play. We're targeting a higher time frame drawn liquidity. So if there was a higher time frame high, which is going to be our PXH, I might make a lecture about PXH and PXL. Drop that in the comments if you want to see that. If we run into a PXH, this will be our draw liquidity. So as we can see, we took our entry around here. our first partial would be at this high on the higher time frame, and then our next full take profit would be where? At a higher time frame, drawn liquidity. So on the lower time frame, our point of interest would be somewhere around up here, because that's where the higher time frame point of interest is. That is where we're moving to. That is where IPDA is referring back to. Once you understand the base concepts of liquidity, you'd understand why the market moves. Because before you start learning any of this, you need to understand why it works before you start using it. And that's exactly what I'm doing inside my mentorship. I'm not only explaining what I use, but I also explain how and why it works. Because the algorithm doesn't only just do things because it wants to do them. It does them because there's algorithmic signatures inside a price that tell it to do things. So now that we understand the concepts of retracement and how we utilize lower time frame market maker models inside of these retracement and expansion legs on the higher time frame, what we're moving to next, what we're going to be talking about now is how we can use equilibrium of the higher time frame range to frame lower time frame setups. These types of setups where I take a trade off of equilibrium of the higher time frame range are one of my favourite because they are so clean and so easy to spot. All you need to do is take your fib and draw equilibrium of the higher time frame range. This is exactly what I've done here. As we can see, we've got equilibrium of a higher time frame range right here. What I want you to notice is in the lower time frame, we form our high inside of our macro time right here, then we displace down, and this displacement leg is usually very big and very powerful. There'll be a lot of volatility down into the equilibrium of the range. Now, why is equilibrium of the range important? Well, the algorithms hedge their positions at every retracement leg. So what does this mean? Well, that means that the algorithms are hedging their positions here, 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 and here. So why is this of any importance? Well, on the higher time frame, they're doing exactly the same thing. The algorithm keeps buying and selling at the same time at every single retracement leg. As we can see, what will start to happen is as the buy positions are in profit, they start selling and closing their positions on the expansion legs. However, these sell positions that they've sold are now in a loss. So what do the algorithms need to do to get back in the money? To get back to at least break even? Because what they've done is they've bought, they keep buying and selling, buying and selling, buying and selling, buying and selling. After they hedge these positions, the long positions are in the money. The long positions that they put on here, 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 here are all in the money. Now after they close these long positions, the sell positions are still in a loss. So what the algorithms need to do, they need to come back to equilibrium, and equilibrium is where they get back to break even. Once their sell positions are in a bit of money, or at least to break even, they close their sell positions. Now, what do you think happens after they close all their positions? They just start doing it again and again and again and again and again. Once they've hit equilibrium of their range, and now they have no positions left, what do? They buy and sell again. They hedge their positions again. So what have they just done? They've bought and sell, and they've closed their positions after one of the expansion legs. Now to get back into break even, they make price sell off into equilibrium. Now their positions are back in the money. They're back at the break even. So now they've made a whole lot of profit and all their losing positions are back at break even. Knowing this allows us to utilize it in our trading. Because the equilibrium of the range is when the algorithm gets back in the money and they start buying again. Now price can move back into its intended direction, which is to the upside. Because why? And why is this? Because we're in bullish order flow. We're looking for buys. So once we've hit equilibrium of the range during our macro time, what do we expect to happen? We expect to form a low, displace up above our intermediate term high, which would be this high right here, because this one formed inside of a civvy. We drop back down into that high, which has now been formed into a breaker. And this is where we get our reaction back up. What I want you to notice is usually there'll be breakaway gaps left somewhere here. And sometimes they're even left on the higher time frame. Breakaway gaps can be used as your drawn liquidity. They are a really high probability drawn liquidity that you can use, meaning once price has dropped down into equilibrium, we've had a small retracement on the lower time frame back into this intermediate term high, where will market run up to and draw into our breakaway gap that we formed here. If price continues to displace to the upside and we close and we displace above this breakaway gap, what do we want to see now? Our next drawn liquidity would be the high that we formed right here. This is our final drawn liquidity. I hope everything I just talked about made sense to you guys. There's a lot of highly technical things right there. However, once you understand how the algorithms hedge their positions and it starts to make sense to you, you can align yourself with the algorithms. Because if you're thinking the same way as the algorithm's thinking, then all you need to do is just press the button. However, you need to understand how and why the algorithm is moving price how it is. So now let's move on to higher time frame PD array selection. Okay, so for our higher time frame PD array selection, what I like to use is discount and premium arrays. Now what does this mean? If I'm looking for buys, I look for PD arrays in the discount of our range. So as you can see, I've kept the premium discount of a higher time frame range. Now even if there was a BISI here, I would not be paying attention to it. Why? Because this is not in the discount of our range. I'd be looking for the first BISI that was formed in the discount of our range. Once price draws into this BISI that's in our discount, then I'm dropping down into the lower time frames. What am I looking for on the lower time frames? Just as everything else, I'm looking for a reaction off of this PD array inside of our macro time, waiting for our CSD, drop back down into the breaker that was formed here, SMT on these lows. Now, what do we target? We target a PD array that was formed in the premium of this displacement leg here. There would be a SIBI formed somewhere around here. As you can see, I've just flipped it around. Now we're using premium of our range because now we're looking to sell our position. We're looking to close our long position with a sell position. So now I'm looking for a premium array, which would be up here. And this is our drawn liquidity for price. If this gets displaced through, then of course, what's our drawn liquidity? This high up here. On the lower time frame, a higher time frame PD array would look something like this. Price draws in. If we displace through, then our drawn liquidity is this high up here, which on the higher time frame would be this high over here. I hope everything made sense to you today, because there's a lot of highly technical things inside of this lecture, but I needed to get through everything because you need to understand the significance of how the algo runs, not just what it does, because that's easy. You can just look on the charts and see what it does. But you need to go a layer deeper. You need to understand why it's doing these things. Because once you understand why, that's when you align yourself with the algorithm. Well, I hope everyone learns something new today. As I mentioned already, I've started a private mentorship group. So if you want to learn about the secrets of the algorithm and how to align yourself with algorithmic price delivery, it's in the description below. I'm also running a free Discord, which is also linked in the description below, and so are my socials. I hope everyone enjoyed this video, and I hope everyone has a great rest of the day. Goodbye.